Good afternoon. It is midday Sunday, March 1st. Actually on vacation this week, but given the geopolitical events happening, wanted to create a short video to give you my perspective on these events. Obviously, we're going to continue to see headlines evolving around these events, and we're going to see some volatility around that. That's normal. That's to be expected. But what's really important here for us as investors is to understand the distinction between a geopolitical event and an economic event. Now, a geopolitical event definitely will impact markets in the short term. They react quickly, and we see volatility around that. But what's more important for us as investors is economic events and understanding if this is an economic event as well as a geopolitical event, because with economic events, you're going to see changes to growth, earnings, inflation, and recession risk. So let's focus a little bit more on that. History has shown that geopolitical events by themselves have created short-term volatility, but not lasting damage to long-term disciplined investor portfolios. Where we see negative events is when investors abandon a disciplined strategy and react emotionally to geopolitical events. Let's take a look at history. Since World War II, there have been more than 24 geopolitical crises that have happened. And in 2/3 of those cases, 3 months after the event began, markets were positive. And when you look out a full year after those events, most of the time the market was above where it was when the event began. Markets adjust in the short term, but historically those adjustments have not defined the long-term success. Now, there is one exception. So the exception is when a geopolitical event becomes an economic event. And I'm already hearing references to oil prices going up and the shock of the 1970s, and that created a meaningful market decline in that time. But we're in a lot different place than we were in the 1970s. The economy has easily absorbed a 10 to 15% increase in the price of oil and not become a big economic event. But in the 1970s, oil prices didn't go up 15, 20%. They quadrupled. And we were really beholden to the oil sources of the Middle East. Now we can produce a lot of our own oil. And so the impact from oil prices, although it could happen short term, does not likely have the potential to become a huge economic factor in the near term. Let me be very clear about something. When we created your portfolio strategy together, we didn't do so based on the belief that markets only decline 5% at a time. We have thought about the fact that we will run into down markets, bear markets during your retirement, and usually 5 or 6 bear markets will happen during a normal retirement. And so the portfolio we put together is really focused on that can and will happen. And we already have a plan for how we will navigate it when it happens. And I'm not even saying that this geopolitical event will cause that kind of a market decline. Again, it's too early to tell, but it is not an economic event at this moment. We're not going to adjust the portfolio based on headlines or short-term market moves. We might adjust it if we see a shift in the economic landscape, but more commonly if your personal goals and situation changes. So the plan right now is to stay steady, stay disciplined, and to stay focused on the long-term plan that we created together for you. If you'd like to talk it through, please reach out. For now, the plan stays intact. As always, thank you for the confidence you place in us. I take that very seriously. That's why I wanted to create this short video. I hope it's been helpful.